Before we begin, it's crucial to understand that this video is for educational and informational purposes only. I am not a financial advisor, and the content presented here should not be considered as financial, legal, or tax advice. Investing involves risk, including the potential loss of principal. You should always conduct your own research and consult with a qualified professional before making any investment decisions. Your financial situation is unique, and any actions you take based on this presentation are solely your responsibility. You've heard the advice 1,000 times. Diversify your portfolio. So you do what you're told. You buy an S&P 500 index fund. You grab a few shares of that hot tech company everyone's talking about. Maybe you even sprinkle in some international stocks for good measure. You look at your brokerage account, see a dozen different names, and you feel safe. You feel diversified. But what if I told you that for 90% of investors, this isn't diversification at all? It's an illusion. It's like thinking you have a balanced diet because you ate 3 different kinds of pizza. You're still exposed to the exact same fundamental risk, just packaged in slightly different boxes. And when the market takes a nosedive like it did in 2000, 2008, and again in 2022, all those different boxes tend to fall at the exact same time. That feeling in the pit of your stomach when you see your life savings drop by 20 or 30% in a matter of weeks. That is the price of fake diversification. But there is a way to build a genuinely resilient, all-weather portfolio. A way to create a financial foundation so strong that market crashes become opportunities instead of catastrophes. The secret isn't some complex trading strategy or a get-rich-quick scheme. It's about understanding the other half of the investment universe that most people completely ignore. Over the course of this series, we are going to pull back the curtain on one of the most powerful, yet tragically misunderstood, tools for building real wealth and true financial peace of mind: debt mutual funds. We will break down exactly what they are, how they work, and how you can use them to build a portfolio that doesn't just grow but endures. This is the knowledge that separates amateur speculators from sophisticated investors. Let's be honest, investing in the stock market can feel like being on the world's most terrifying roller coaster. One minute you're on top of the world, your portfolio is hitting all-time highs, and you feel like a genius. The next, a single tweet or an inflation report sends everything plummeting, and you're left wondering if you should just sell it all and hide your cash under a mattress. This is the nature of owning stocks, or what we call equity. When you buy a share of a company, you're buying a tiny piece of ownership. You are a part owner. If the company does incredibly well, your share of the pie gets bigger, and you can make a fortune. But if the company struggles, or if the entire economy hits a rough patch, your ownership stake can become worth a lot less, or even nothing at all. It's the ultimate high-risk, high-reward game. And for a long time, the prevailing wisdom has been to just ride it out. Don't panic, it'll come back, they say. And historically, it has. But that advice ignores the brutal human element. It ignores the sleepless nights. It ignores the people who were forced to sell near the bottom because they were retiring or needed the money for an emergency. Riding out a 50% drop is a lot easier on paper than it is in real life. This is where the other side of the coin comes in. Imagine instead of being a part owner of a company, you could be its bank. Instead of sharing in the volatile ups and downs of its profits, you simply lend the company money. In exchange, the company gives you a formal IOU, a promise to pay you back the full amount on a specific date, and in the meantime, they agree to pay you regular, fixed interest payments. You don't get the explosive upside if the company invents the next iPhone, but you also don't get wiped out if they have a bad quarter. You get your interest and then you get your principal back. Predictable, steady, boring in the best possible way. This, in a nutshell, is a bond. It's a form of debt, and it is the fundamental building block of a truly diversified portfolio. While stocks represent ownership, bonds represent loans. They are 2 completely different asset classes that behave in fundamentally different ways. Often, when the stock market is in a panic and everyone is selling stocks, they are running towards the perceived safety of high-quality bonds, which can cause bond prices to go up while stock prices are going down. They are the yin to the stock market's yang. Okay, you might be thinking, that makes sense. I'll just go buy some bonds. But it's not that simple. Which bond do you buy? A U.S. Treasury bond, considered the safest in the world? A corporate bond from a blue-chip company like Apple? Or a higher-yielding but riskier bond from a newer company? And for how long? Should you buy a 2-year bond, a 10-year bond, a 30-year bond? How do you analyze the company's creditworthiness to make sure they can actually pay you back? The truth is, buying individual bonds is often more complex, and requires more capital than buying individual stocks. To be properly diversified, you'd need to buy dozens of different bonds from different issuers with different maturity dates, which for the average person is a logistical nightmare. And this is where the genius of the debt mutual fund comes in. A debt mutual fund is simply a professionally managed pool of money from thousands of investors, all put together for one purpose: to buy a diversified portfolio of bonds. Think of it like an investment club. Instead of you having to do all the research, vet all the companies, and manage all the different interest payments and maturity dates, a team of full-time professionals does it for you. For a small fee, you get instant access to a basket of maybe hundreds or even thousands of different bonds. You get instant diversification. You get professional management. You get the stability and income-generating power of the bond market, all wrapped up in a single easy-to-buy package, just like a stock. So why is this so critically important? It's because debt funds play a role in your portfolio that stocks simply cannot. Their primary job isn't necessarily to make you rich overnight. It's to keep you rich. First, they provide capital preservation. They act as a defensive anchor, a bedrock for your portfolio designed to hold its value, or even appreciate, when your stocks are getting hammered. Second, they generate regular income. Those interest payments from all the underlying bonds are collected by the fund and can be paid out to you, the investor, creating a predictable stream of cash flow. This can be a powerful tool for those nearing retirement or for anyone who wants their portfolio to generate a paycheck. But most importantly, they provide the psychological stability to stick with your long-term plan. They are the suspension system on your financial vehicle. When you drive over the inevitable potholes and bumps of the stock market, a portfolio with a healthy allocation to debt funds won't rattle your teeth. The ride is smoother. It reduces the volatility, which in turn reduces the panic, which in turn prevents you from making the single biggest mistake an investor can make, selling at the worst possible time. It's this shock-absorbing quality that allows you to stay invested in your stocks for the long run, which is where the real growth happens. But here's the critical part, and what we're going to dissect in the rest of this series. Not all debt funds are created equal. The term debt fund is a massive umbrella category, like the term car. A Ferrari and a minivan are both cars, but you wouldn't use them for the same purpose. Similarly, some debt funds are incredibly safe, like short-term U.S. Treasury funds. Others, like high-yield or junk bond funds, can be nearly as volatile as stocks. The key is understanding the difference. It all comes down to two crucial concepts: credit quality and duration. These two words are the secret language of the bond market, and once you understand them, you will be able to look at any debt fund and know exactly what its purpose is, how much risk you're taking, and whether it belongs in your portfolio. And that is exactly what we are going to master starting right now. At its absolute core, a debt mutual fund is unbelievably simple. Forget the jargon, forget the complicated charts for just a moment. Imagine you are a lender. Your job is to lend money to people or organizations who need it, and in return for taking that risk, they pay you interest. That's it. That's the entire business model. A debt mutual fund is just a giant pool of money, collected from thousands of investors like you and me, that is professionally managed by a team whose only job is to lend that money out to generate a steady, predictable income. So, the first big question is, who are we lending all this money to? Well, it's not your cousin who needs a few bucks for a new business idea. The borrowers in this world are some of the biggest and most stable entities on the planet. First, you have governments. The US federal government is the single biggest borrower. When you hear about the national debt, what that really means is the government has borrowed trillions of dollars by issuing what are called treasury bonds or T-bills. They do this to fund everything from infrastructure projects and social security to the military. By investing in certain debt funds, you are literally lending money to the US government, which is considered one of the safest investments in the entire world because the government has the power to tax its citizens to pay you back. You can also lend to state and local governments, who borrow money to build schools, fix roads, and fund public services. These are called municipal bonds. The second major group of borrowers is corporations. Think of the biggest companies you know: Apple, Coca-Cola, Johnson & Johnson. Even these massive, cash-rich companies need to borrow money constantly. They might need to build a new factory, develop a new product, or acquire a smaller company. Instead of going to a single bank for $1 billion loan, they often borrow it from the public by issuing corporate bonds. Now that word, bond, sounds official, maybe a little intimidating, but all a bond is a fancy IOU. It's a formal contract. When a debt fund buys a bond from, say, Microsoft, it's a piece of paper that says, Microsoft promises to pay you back the money you lent us on a specific date in the future, and along the way we promise to pay you a fixed amount of interest every year. That interest payment is called the coupon, and the date they promise to pay you back the principal is called the maturity date. So, if you buy a 10-year bond with a 5% coupon, you get paid 5% interest every year for 10 years, and at the end of the 10th year you get your original money back. It's designed to be a predictable, reliable stream of income. So, why not just go out and buy these bonds yourself? Why do we need the mutual fund part? 3 reasons: diversification, expertise, and access. First, diversification. If you had $10,000 and you lent it all to one single company, and that company went bankrupt, you'd lose everything. But a mutual fund takes our collective money and lends it out to hundreds, sometimes thousands of different governments and corporations. Some might be ultra-safe government bonds, some might be slightly riskier corporate bonds with higher interest rates. If one of those hundreds of borrowers fails to pay, it's a tiny blip in the overall fund, not a catastrophe for your investment. It's the classic rule: don't put all your eggs in one basket. Second, expertise. The managers of these funds are professionals. Their entire job all day, every day, is to analyze the financial health of these borrowers. They do a deep dive credit check, far more detailed than anything we could do on our own, to determine how likely a company is to pay back its loan. They are essentially professional risk managers working on your behalf. And third, access. Many individual bonds, especially corporate bonds, are traded in large blocks, often $100,000 or more. For the average investor, that's just not practical. A mutual fund gives you the ability to own a tiny slice of all these different bonds for as little as a few $100s, or even less. Okay, so it's a pool of money lent to governments and corporations in exchange for interest. It's diversified and professionally managed. Sounds perfect. Sounds completely safe. But as with any investment, there is no free lunch. There are risks involved. And if you understand these 2 primary risks, you will understand the entire world of debt funds. Every single debt fund that exists is just a different combination of these 2 risk factors. The first risk is the easy one to understand. It's called credit risk or default risk. This is simply the risk that the borrower won't be able to pay you back. It's the risk that your friend who borrowed money from you suddenly loses their job and says, "Sorry, I can't pay." In the world of bonds, this is where credit ratings come in. You've probably heard of agencies like Moody's and Standard & Poor's. Their job is to rate the creditworthiness of these borrowers. They assign letter grades just like in school. A borrower with a AAA rating is like the valedictorian of the financial world. Incredibly reliable, rock solid, with an almost zero chance of defaulting. The US government is a prime example. As you go down the scale to AA then BBB, the risk gets slightly higher. These are still considered investment grade, meaning they are solid, reliable companies. But once you drop below that, you get into bonds rated BB, BCCC, and so on. These are known as high-yield bonds, or to use the more common term, junk bonds. These are issued by companies that are less financially stable. Because they are riskier, they have to entice lenders by offering a much higher interest rate, a higher coupon. So, credit risk is a spectrum. You as an investor have to decide. Do you want the safety of lending to a AAA-rated entity for a lower interest rate? Or are you willing to take on the higher risk of lending to a B-rated company for a much higher potential return? Now for the second risk. This is the one that trips most people up, but I promise if you get this, you'll be ahead of 90% of investors. It's called interest rate risk. This has nothing to do with the borrower's ability to pay you back. This is a risk that affects even the safest AAA-rated government bonds. The concept works like a seesaw. When new interest rates in the economy go up, the price of your existing older bonds goes down. Let me explain with a simple example. Imagine you buy a 10-year bond today for $1,000 that pays you a 5% coupon. That means you get $50 of interest every year. You're happy. But next year, the Federal Reserve raises interest rates to fight inflation. Now new bonds being issued are paying a 7% coupon. They pay $70 a year for the same $1,000 investment. Suddenly, your 5% bond looks a lot less attractive, doesn't it? If you wanted to sell your bond to someone else, why would they pay you the full $1,000 for your bond that only pays $50 a year, when they could go out and buy a brand new one that pays $70 a year? They wouldn't. The only way you could convince them to buy your bond is by selling it at a discount. You might have to sell it for, say, $900. The price of your bond has gone down. The reverse is also true. If interest rates in the economy fall to 3%, your old 5% bond suddenly looks amazing. Everyone wants it. You could sell it for more than you paid for it, maybe $1,100. The price of your bond has gone up. That is the seesaw. New rates go up, your bond's price goes down. New rates go down, your bond's price goes up. This risk is more pronounced for bonds with longer maturity dates. A 30-year bond is far more sensitive to interest rate changes than a 1-year bond, because you're locked into that interest rate for a much longer period of time. This sensitivity is a concept called duration, which we will explore in a later part, but for now, just remember the seesaw. So there you have it. Credit risk and interest rate risk. These are the two fundamental levers, the two control dials that every debt fund manager in the world uses. Every single debt fund you will ever see is just a different strategy for managing these two risks. Some funds aim for zero credit risk by only holding government bonds. Other funds take on a lot of credit risk to chase high yields. Some funds try to minimize interest rate risk by holding very short-term bonds, while others use long-term bonds to try and capitalize on falling rates. These two risks, the risk of default and the risk of changing interest rates, are the DNA of every debt fund. And now that we have that framework, we can finally start to break down the actual categories of funds you'll see when you go to invest. We can start to put names and faces to these strategies. Let's start on the safest, most predictable end of the spectrum. Think of these first few funds as the financial equivalent of your home's entryway. It's where you put things you need to grab at a moment's notice: your keys, your wallet, your emergency cash. This isn't where you store your family heirlooms. It's all about immediate access and safety. The first category here is called overnight funds. The name tells you almost everything you need to know. These funds invest in securities that mature and, you guessed it, one day. One single day. The fund manager buys a security today, and it matures tomorrow, returning the principal plus a tiny sliver of interest. They do this over and over and over again. Because the time horizon is literally 24 hours, the risk is about as close to zero as you can get in the investing world. There's virtually no interest rate risk. How much can rates really change in a day to affect your bond's price? And there's almost no credit risk because they're lending to the most secure institutions like the government or massive corporations for just one night. The trade-off? The returns are, as you'd expect, very low. They'll typically hover just around the central bank's policy rate. So why would anyone use this? It's for giant corporations or institutions that need to park millions of dollars over a weekend and can't just leave it in a non-interest-bearing checking account. For most individual investors, it's a little too safe, a little too low return. So we take one small step up the ladder to a category that is immensely more useful for the rest of us: liquid funds. These are the true workhorses for short-term cash management. A liquid fund invests in debt instruments that mature in up to 91 days, about 3 months. Think of things like treasury bills, commercial paper from blue-chip companies, and certificates of deposit. Again, the goal here is not to make you rich. The goal is safety and liquidity. The number one priority is to protect your principal. The number two priority is to give you access to your money almost instantly. And the number three priority, a distant third, is to earn a little bit more interest than a standard savings account. This is the perfect place to park money you know you'll need soon. Your emergency fund? A down payment for a house you plan to buy in the next 6 months? Money you're setting aside for a big tax bill? A liquid fund is a fantastic candidate, because the average maturity of the bonds inside is so short, usually around 30 to 60 days, they are highly insulated from interest rate shocks. If the Fed raises rates, the fund manager doesn't panic. They just hold the short-term bonds until they mature a few weeks later, and then reinvest the cash at the new, higher rates. This makes their returns very stable and predictable. The risk is minimal, the returns are modest, but the peace of mind is enormous. It's the ultimate parking lot for your cash. But what if your time horizon is in a few weeks or a couple of months? What if you have money you won't need for, say, 6 to 12 months? You're willing to take a tiny bit more risk for a tiny bit more return, but you still want it to be incredibly safe. You're not looking for a parking lot anymore. Maybe you're looking for short-term storage. This is where we enter the next two closely related categories: ultra-short duration funds and low-duration funds. These names can be a bit of a mouthful, but the concept is simple. We're just extending the maturity profile a little bit. An ultra-short duration fund will typically hold bonds with an average maturity of about 3 to 6 months. A low-duration fund stretches that out a bit further to maybe 6 to 12 months. See the pattern? We're slowly, carefully walking out along the timeline. By extending the maturity, these funds can capture slightly higher yields. A company will pay you a little more interest to borrow your money for 6 months than they will for 30 days. It makes intuitive sense. But with that extra potential return comes a little extra risk. Now, a 6-month or 1-year bond is still very safe. But it has slightly more interest rate risk than a 30-day bond. If the Fed unexpectedly hikes rates, the value of these bonds will dip a little more than the bonds in a liquid fund. It's not a catastrophic drop, but it's a noticeable wobble. The fund manager has a bit less flexibility to just wait for everything to mature and reinvest at the new, higher rates. So, choosing between a liquid and ultra-short and a low-duration fund is a direct reflection of your time horizon. If you might need the money next month, you stick with the liquid fund. If you're confident you won't need it for at least 6 months, an ultra-short fund might give you a slightly better return without causing you to lose sleep at night. It's all about matching the fund's characteristics to your specific financial goal. You wouldn't use a sledgehammer to hang a picture frame, and you wouldn't use a tiny tack hammer to break up concrete. It's about picking the right tool for the job. Now let's keep walking down this path. We've covered overnight, a few months, and up to a year. What about the 1 to 3 year time frame? This is a really common goal. Maybe you're saving for a new car in 2 years. Or you're planning a wedding. Or you just have a chunk of cash you want to keep safe but still want it to work a little harder for you than the ultra-safe options. This brings us to the short duration fund category. Notice the naming convention: ultra-short, low, and now just short. A short duration fund typically invests in bonds with an average maturity of 1 to 3 years. And this is where the balance between risk and reward starts to become much more of an art. At this point, interest rate risk is no longer a tiny little gremlin. It's a real factor the fund manager has to actively manage. A surprise rate hike from the Fed can cause a meaningful, though still temporary, drop in the fund's net asset value. At the same time, the fund manager has more room to play with credit risk to generate higher returns. They might start to include a larger portion of high-quality corporate bonds instead of just government securities. They're looking for that sweet spot, taking on just enough calculated risk to deliver a return that's noticeably better than cash, without exposing you to the volatility of the stock market. For a 1 to 3 year goal, these funds can be a fantastic middle ground. And I have to mention a special player in this short-term space, one you've definitely heard of: the money market fund. Now this is critical. A money market fund is a type of mutual fund, just like the others we've discussed. It is not the same as a money market account that you get at a bank. A bank account is FDIC insured. A money market fund, like all mutual funds, is an investment and is not. However, they are governed by incredibly strict rules. They can only invest in the highest quality, shortest term debt, very similar to liquid funds. Their main goal is to maintain a stable net asset value, or NAV, of $1 per share. They are engineered from the ground up for stability and safety. Historically, they've been an incredibly reliable way to earn a bit of yield on your cash. They fit right in with liquid and ultra-short funds as a high-safety, high-liquidity option. So let's pause and take a breath. We've just built the entire foundation of a debt fund portfolio. We have the overnight and liquid funds for our immediate cash needs, the digital mattress. We have the ultra-short and low-duration funds for goals that are just a few months to a year away, our short-term savings boosters. And we have short-duration funds for that 1 to 3 year sweet spot, where we're willing to stomach a little bit of volatility for a healthier return. All of these funds live on what we call the short end of the curve. Their primary identity is shaped by managing liquidity and credit quality, while keeping interest rate risk on a very tight leash. They are the bedrock. But this is also where the story gets really interesting. Because what happens when we let that leash out? What happens when we step beyond the 3-year mark and venture into the world of medium and long-duration funds? That's when interest rate risk stops being a minor character and becomes the star of the show, capable of delivering both thrilling returns and gut-wrenching losses. And that is exactly where we're going next. So let's step onto that stage. Imagine 2 spotlights. One is on credit risk, the other on interest rate risk. In the funds we've discussed so far, the liquid funds, the short-duration funds, the spotlight on credit risk is bright, while the one on interest rate risk is a dim little flicker. It's there, but it's not the main event. When you enter the world of medium and long-duration funds, that lighting board gets a complete overhaul. The credit risk spotlight might stay the same, but the one on interest rate risk? It cranks up to a blinding stadium-level intensity. It defines everything. A medium duration fund typically holds bonds with a portfolio duration of, say, 3 to 7 years. A long duration fund pushes that out even further, often 7 years and beyond. Now, why on earth would anyone willingly sign up for more risk? For the exact same reason a surfer paddles out to catch a bigger wave. The potential for a much more thrilling ride. The potential for significantly higher returns. To understand this, we need to truly master the single most important concept in bond investing, the seesaw. We've touched on it, but now we need to live it. On one end of the seesaw, you have interest rates in the economy, let's say the rate set by the Federal Reserve. On the other end, you have the price of existing bonds. When interest rates go up, bond prices go down. When interest rates go down, bond prices go up. It's an inverse relationship. Always. Now, the length of your fund's duration is like the length of the seesaw plank. With a short duration fund, you have a tiny little seesaw like one at a toddler's playground. When interest rates move a bit, the other end of the seesaw moves a bit. It's manageable, not very volatile. But with a long duration fund, you're not on a playground seesaw anymore. You are on a colossal 100-foot-long steel beam balanced on a pinpoint. The tiniest, most delicate nudge on the interest rate side sends the other side. Your bond prices, your fund's value, soaring into the sky or crashing into the ground with terrifying force. This is not a bug. It's the entire feature. This sensitivity, this extreme volatility is what these funds are all about. Let's play this out in a real-world scenario. Imagine it's 2024, and you believe the economy is slowing down. You predict that the Federal Reserve in the next year or two will have to start cutting interest rates to encourage growth. So, you invest in a long-duration bond fund. This fund buys a portfolio of bonds, maybe 10-year and 30-year U.S. Treasuries, that are currently paying, let's say, a 4.5% coupon. You're locking in that 4.5% yield. Now fast forward a year. Your prediction was right. The Fed has cut rates. New 10-year and 30-year bonds being issued are now only paying 3.5%. Suddenly, the bonds your fund is holding, the ones paying 4.5%, look incredibly attractive. They are a golden ticket from a bygone era. Everyone wants them. The demand for your fund's bonds skyrockets. And because of that long seesaw, their price doesn't just nudge up, it leaps upwards. The net asset value or NAV of your fund shoots up. You're not only collecting the steady coupon payments, but you've also made a significant capital gain on the price of the bonds themselves. This is the home run. This is the moment investors in these funds live for. You use duration as a lever to amplify the impact of falling interest rates, and it paid off handsomely. But that lever works in both directions. Let's rewind and paint the opposite picture. You buy the same long-duration fund holding bonds that pay 4.5%. But instead of slowing down, the economy stays hot. Inflation proves stubborn. The Fed, instead of cutting rates, is forced to hike them further. Suddenly, new bonds are being issued that pay 5.5%. Now, who wants the old 4.5% bonds your fund is holding? Nobody. They look like a terrible deal. To sell them, your fund manager would have to offer them at a steep discount. The price of the bonds in your portfolio plummets. And because you're on that giant 100-foot seesaw, the NAV of your fund doesn't just dip, it craters. You are now facing a significant paper loss. This is the gut-wrenching downside. The exact same force, that powerful duration lever, is now working against you, amplifying the negative impact of rising rates. This is why these funds are considered strategic tools, not just simple savings instruments. They are a bet on the future direction of interest rates. The fund managers running these portfolios are not passive coupon collectors. They are macroeconomists, Fed watchers, and strategists. They are constantly analyzing economic data, inflation reports, and employment numbers, trying to position their portfolio on the right side of that seesaw. They might shorten the fund's duration if they expect rates to rise, and lengthen it if they expect rates to fall. You are, in essence, hiring a professional to make these high-stakes interest rate bets on your behalf. So, who uses these funds? They are often used by investors with a long time horizon, who can withstand the volatility. They can also be a powerful tool for portfolio diversification. Think about it. In a major economic downturn or a stock market crash, what does the Federal Reserve usually do? It cuts interest rates aggressively to stimulate the economy. In that scenario, while your stock portfolio might be bleeding, your long-duration bond fund, benefiting from those rate cuts, could be soaring, acting as a crucial buffer and balancing out your overall returns. It's a sophisticated way to build a truly all-weather portfolio, but it requires a different mindset. You cannot look at the daily value of a long-duration fund and panic. It will be volatile. It will have periods of poor performance, especially during rate hike cycles like the one we saw in 2022 and 2023, which were historically brutal for these funds. The key is understanding why you own it. Are you owning it for the steady income? Probably not. There are better, less volatile options for that. You are owning it for its strategic potential. The ability to deliver strong capital appreciation when interest rates eventually fall, and its power to act as a diversifier against stock market risk. It's crucial to remember that credit risk hasn't vanished either. A long-duration fund can choose to buy ultra-safe long-term U.S. Treasury bonds, where the credit risk is near zero, making it a pure play on interest rates. Or it could buy long-term corporate bonds. These will offer a higher yield to compensate for the added credit risk, the risk that the company could default over that long 10, 20, or 30-year period. This adds another layer of complexity and another potential source of return or risk. You have to decide which risk you're more comfortable with, or how you want to blend them. So we have this epic battle between two primary forces. Credit risk, the fear of a borrower not paying you back, and interest rate risk, the seesaw effect of the broader economy. Most funds we've discussed are a blend of both. But what if you wanted to simplify the equation? What if you could step into the ring and bet on just one of the fighters? What if you wanted to side exclusively with the US government, taking credit risk almost completely off the table, to play a pure, unadulterated interest rate game? That's where government securities funds enter the picture, and they change the rules entirely. These funds are the financial equivalent of building your house out of solid granite. In a world of financial storms, they are the bomb shelter. When you invest in a government securities fund, or a GSEC fund, you are making a single powerful statement. You trust the United States government to pay its bills more than anyone else on the planet. Period. Because that's all these funds do. They buy debt issued by the U.S. Department of the Treasury and various other government agencies. We're talking about a portfolio that has essentially stripped away credit risk. The chance of the U.S. government defaulting on its debt is, for all practical purposes in modern finance, considered to be zero. It has the power to tax its citizens and, in the most extreme case, print more money to pay its debts. No corporation, no matter how big, has that power. So, when you buy into a GSEC fund, you're not worrying if the borrower will be able to pay you back. You know they will. The real question, the entire game you are playing here, is not about if you'll get paid back, but how much your investment will be worth while you wait. You've traded credit risk for a pure, unfiltered exposure to interest rate risk. Let's unpack the treasure chest. What exactly is inside one of these funds? It's not just one type of government IOU. The managers of these funds are picking and choosing from a menu of securities, each with its own flavor and characteristics. First, you have the sprinters, U.S. Treasury bills or T-bills. Think of these as very short-term loans to the government, maturing in 1 year or less. Because their lifespan is so short, they are the least sensitive to changes in interest rates. If the Fed raises rates tomorrow, a 3-month T-bill doesn't really care that much. It's going to mature so soon that the rate change barely has time to affect its value. The return is low, but the stability is incredibly high. Funds that focus on these are aiming for maximum safety and liquidity, acting almost like a high-powered savings account. Next up are the middle distance runners. U.S. Treasury notes or T-notes. These have maturities ranging from 2 to 10 years. Here things get more interesting. You're locking your money up with the government for a longer period, so you demand a higher interest rate, a better yield for your trouble. But with that longer time frame comes more sensitivity to interest rate changes. Remember our seesaw analogy? A T-note is a longer plank than a T-bill. A small push on one end, a change in interest rates, causes a bigger movement on the other end, the bond's price. And finally, we have the marathon runners, U.S. Treasury bonds or T-bonds. These are the long haulers with maturities of more than 10 years, typically going out to 20 or even 30 years. This is where you find the highest yields in the Treasury world, because you are making the longest commitment. But this is also where interest rate risk becomes a powerful, dominant force. A 30-year T-bond is the longest, most sensitive seesaw in the playground. A mere 1% increase in prevailing interest rates can cause the market price of that bond to fall dramatically, sometimes by 10% or more. So, a fund holding a lot of these long bonds can see its net asset value, its share price, swing much more than you might expect from something labeled government securities. So, a GSEC fund manager is like a chef deciding on the right mix of these ingredients. A short-term treasury fund will be packed with T-bills and short T-notes, prioritizing stability over yield. A long-term treasury fund, on the other hand, is loaded with T-bonds, making a big bet that interest rates will stay low or fall. If they're right, the value of those long bonds will soar. and the fund will deliver fantastic returns. If they're wrong and rates spike, the fund's value will get hammered. But wait, there's another layer here. It's not just about treasuries. Many GSEC funds also invest in what are called agency bonds. These are issued by government-sponsored enterprises. You've probably heard their names: Ginnie Mae, Fannie Mae, and Freddie Mac. These are the entities that play a huge role in the U.S. housing market, buying up mortgages from lenders and packaging them into securities. Now here's a critical distinction, the kind of detail that separates savvy investors from the crowd. Debt from Ginnie Mae is backed by the full faith and credit of the United States government. It's considered just as safe as a treasury bond. But debt from Fannie Mae and Freddie Mac is not. It has an implicit government guarantee. Everyone believes the government would step in and bail them out if they got into trouble, as they did in 2008, but it's not an explicit, legally binding promise. Because of this tiny sliver of uncertainty, these agency bonds typically pay a slightly higher interest rate than comparable treasury bonds. A fund manager might add these to their mix to juice the yield just a little bit, without taking on what most people would consider significant credit risk. So, who is the ideal investor for a GSEC fund? It's someone who has decided that avoiding default is their number one priority. This is the bedrock portion of a portfolio. It's the anchor in a storm. If you're retired and relying on your investments for income, a short-term GSEC fund can provide that income with an extremely high degree of reliability. If you're a younger investor, you might use a GSEC fund as the core stabilizer in your portfolio, the part that zigs when your stocks are zagging. It's the defensive line on your financial football team. The trade-off is clear. You are sacrificing the potential for higher returns that you could get from corporate bonds. You're accepting a government-sized return for government-sized safety, and you have to be acutely aware of what kind of GSEC fund you're buying. Are you buying the short-term stable fund that will chug along predictably? Or are you buying the long-term volatile fund that is essentially a leveraged bet on the future direction of interest rates? One is a calm harbor. The other can be a stormy sea, even if the water itself, the credit quality, is perfectly pure. By isolating your risk down to just one primary factor, interest rates, you can make a very clean, very specific bet. You're no longer worried about a CEO making a bad decision or a company's sales falling off a cliff. Your entire focus is on the Federal Reserve, on inflation, on the macroeconomic picture that drives the cost of borrowing money for the most powerful entity in the world. You've built your fortress. The walls are thick, the guards are loyal, and the risk of an invasion from corporate defaults is zero. Feels safe. Feels secure. But the returns, while steady, are modest. You look out from the top of your fortress and see the bustling city below. You see skyscrapers with names like Apple and Microsoft and Johnson & Johnson. They're building, innovating, and growing, and to do that, they also need to borrow money. What if you were willing to step outside your government-guaranteed walls and lend directly to them? What if you wanted to finance the next great American innovation? That's when you leave the sovereign safety of GSEC funds and enter the dynamic, sprawling metropolis of corporate bond funds, where the potential rewards are far greater, and the dangers take on an entirely new form. Imagine this metropolis. It's not made of steel and glass, but of ambition and capital. The skyline isn't dominated by skyscrapers, but by the logos of America's greatest companies. This is the world of corporate bonds. Every company you know, from the tech giant that built your phone to the coffee shop on the corner, needs money to grow, to innovate, to build. And often, instead of selling a piece of themselves through stocks, they borrow. They issue a bond. And a corporate bond fund is your ticket to becoming the lender to this entire ecosystem. When you buy a share in one of these funds, you're not just buying a piece of paper. You're funding the next breakthrough drug. You're providing the capital for a new factory that will employ thousands. You're helping lay the fiber optic cable that will connect a rural town to the world. It's a direct participation in the engine of the American economy. But this city, like any great metropolis, has its districts. Some are pristine, safe, and impeccably managed. Others are less so. How do you tell them apart? How do you know if you're lending to a fortress of industry or a house of cards? You look at the city's official zoning guide. The credit rating. Think of credit rating agencies, companies like Moody's, Standard & Poor's, and Fitch, as the city's most ruthless, unforgiving building inspectors. They go into every single company that wants to borrow money and they scrutinize everything. They look at the blueprints, the company's balance sheet. They test the foundation, the company's cash flow. They analyze the neighborhood, the industry it operates in. And after all that, they assign a grade, a rating that tells you exactly how likely that company is to pay you back. The highest rating is AAA. These are the titans, the bedrock institutions of our economy. Think of a company that has been dominant for a century, with a product so essential it's practically a utility. Lending to them is almost as safe as lending to the government itself. The building inspector has declared this skyscraper to be a nuclear-proof bunker. As a result, they don't have to offer a very high interest rate or yield to convince you to lend them money. Why would they? The line of lenders is a mile long. Then you have the AA and single-A rated companies. These are still premier blue-chip corporations, the architectural marvels of the skyline. They are incredibly strong, stable, and have a very low risk of not paying you back. The yield they offer is a bit higher than the AAA companies, a small premium for a tiny, almost imperceptible increase in risk. This top tier of bonds, AAA, AA, and single A, are known as high-grade or investment-grade corporate bonds. A fund that specializes in these is like buying real estate exclusively on Park Avenue. It's prestigious, it's stable, and while the returns won't make you a millionaire overnight, they provide a steady, reliable income stream that's a step up from government bonds. But what happens when we leave Park Avenue? What happens when we venture into the up-and-coming neighborhoods, the innovation districts where the next big thing is being built right now? We enter the world of BBB-rated bonds. These are still considered investment grade, but they're on the bottom rung of that ladder. The building inspector has signed off, but maybe noted a few cracks in the facade. The company is solid, but perhaps it's in a more volatile industry, or it has a bit more debt than its A-rated peers. To compensate you for this slightly higher risk, the yield, the interest they pay you, is noticeably better. For many investors, this is the sweet spot. A healthy balance of reasonable safety and attractive income. And then we cross the tracks. Anything rated below BBB is what the industry calls high-yield bonds. Wall Street, in its typical charming fashion, has a more famous name for them: junk bonds. Now, that name is a bit of a misnomer. It's not garbage, it's just risky. These are the bonds issued by companies that the building inspectors have serious reservations about. Maybe it's a young company trying to disrupt an entire industry. It could become the next Amazon, or it could be bankrupt in 18 months. Maybe it's an older company in a declining industry, fighting to reinvent itself. Or maybe it's a company that simply took on too much debt to fund a big acquisition. The foundation is shaky. The blueprints are ambitious but unproven. The risk that this company will default, that it will fail to make its interest payments or pay you back your principal, is real and significant. So why on earth would anyone invest in this? One word: yield. Because the risk is so high, these companies have to offer spectacular interest rates to attract lenders. The potential returns can blow investment-grade bonds out of the water. A high-yield bond fund is a portfolio of these lottery tickets. The fund manager's job is to be an expert speculator, to sift through the junk to find the hidden gems. The companies that everyone else has underestimated. The ones that will not only survive, but thrive and pay those massive yields along the way. Investing in a high-yield fund is like being a venture capitalist for the debt world. The potential for reward is enormous, but the potential for loss is just as great. If one of the companies in the fund goes bankrupt, that bond can become worthless overnight. That's why diversification within the fund is so critical. The manager might buy bonds from 100 different high-yield companies, knowing that a few might fail, but hoping the spectacular returns from the winners will more than compensate for the losers. So you have two main types of corporate bond funds: the stable, reliable investment-grade funds, and the high-risk, high-reward, high-yield funds. But there's another layer of complexity here. Another dial you can turn to customize your investment: duration. Just like with government bonds, corporate bonds are issued for specific time periods. A company might borrow money for 2 years or 5 years or even 30 years, and this creates different categories of funds. A short-term corporate bond fund invests in bonds that will be paid back in just a few years. This dramatically reduces interest rate risk. Remember, if the Fed raises rates, your older, lower-rate bonds become less valuable. But if your bonds are maturing in just a year or two, you'll get your money back quickly and can reinvest it at the new, higher rates. The trade-off? The yields are lower. You're sacrificing higher income for higher stability and protection against rate changes. An intermediate-term corporate bond fund, typically investing in bonds with 5 to 10-year maturities, tries to strike a balance. It offers better yields than a short-term fund, but comes with more interest rate risk. This is often the default choice for investors who want a solid, middle-of-the-road option. And then you have the long-term corporate bond funds. These funds buy bonds that won't mature for 20 or 30 years. To convince you to lock up your money for that long, companies have to offer the highest yields. The income potential is fantastic, but the interest rate risk is massive. If rates go up, the value of those 30-year bonds can plummet. It's a high-stakes game, best suited for investors who have a long time horizon and a strong stomach for volatility. So, when you look at a corporate bond fund, you're looking at a two-part identity. First, what is its credit quality? Is it a high-grade fund shopping on Park Avenue, or a high-yield fund digging for gold in the risky districts? Second, what is its duration? Is it a short-term fund playing it safe, a long-term fund chasing yield, or an intermediate-term fund splitting the difference? Choosing the right one depends entirely on your goals. Are you nearing retirement and need stable income with low risk? A short-term, high-grade corporate bond fund might be your fortress. Are you young with a high-risk tolerance, seeking to maximize your income over the next 30 years? A high-yield fund might be the adrenaline rush you're looking for. We've now explored the two primary continents of the debt fund world: the ultra-safe, sovereign territory of government bonds, and the sprawling, dynamic metropolis of corporate bonds. But these two worlds aren't entirely separate. There are funds that act as bridges, as explorers, as specialists who don't confine themselves to just one. They operate in the gray areas, using complex strategies to hunt for value wherever they can find it. These are the funds that can adapt to a changing economic landscape, shifting from government safety to corporate opportunity in the blink of an eye. They are the chameleons of the bond world, and they play by a completely different set of rules. These funds are called dynamic bond funds. The name itself hints at their nature. They are not static. They are not anchored to a specific point on the duration spectrum. A short-duration fund manager must keep their portfolio's average maturity low. A long-duration fund manager must keep it high. They are given a lane, and they have to stay in it. The manager of a dynamic bond fund, however, is given the entire highway. Their mandate is not to stick to one duration, but to actively change the portfolio's duration based on their view of where interest rates are headed. This is active management in its purest form. The fund manager and their team of analysts are essentially economic detectives. They are poring over every piece of data they can find. What's the latest inflation print? What was the tone of the last Federal Reserve press conference? Is the jobs report showing a cooling economy, or one that's still running hot? They are trying to answer one single multi-billion-dollar question: what is the Fed going to do next, and how will the bond market react? When they believe interest rates are poised to fall, they will act decisively. They'll sell off their shorter-term bonds and load up the portfolio with long-duration government and corporate bonds. They are extending the portfolio's duration, making it highly sensitive to falling rates, positioning it to capture the maximum possible capital appreciation. They are, in essence, stepping on the gas. Conversely, if their analysis suggests that inflation is becoming a problem and the Federal Reserve is about to start hiking rates, they will do the complete opposite. They will sell those long-duration bonds and retreat into the safety of short-term instruments, money market securities, and cash equivalents. They are shortening the portfolio's duration, minimizing its sensitivity to rising rates, and protecting the fund's capital from the brutal price declines that rising rates inflict. They are hitting the brakes and pulling over to the side of the road to let the storm pass. The appeal is obvious. It's the promise of having an expert pilot navigating the treacherous waters of the bond market for you. It offers the potential to generate returns in both rising and falling interest rate environments, capturing upside when rates fall and preserving capital when they rise. In theory, it's the best of all worlds. It's the tactical all-weather solution that many investors dream of. But here's the critical catch. It all hinges on the fund manager being right. And they have to be right not just once but consistently. This introduces a completely different kind of risk that we haven't really discussed yet: manager risk. You are not just investing in a strategy. You are investing in a person or a team and their ability to predict the future. And let's be honest, predicting the direction of interest rates is one of the hardest games in finance. Even Nobel laureates get it wrong. If the manager makes the wrong call, if they go long just before a surprise rate hike, or go short just before an unexpected rate cut, the fund can underperform dramatically. It can get caught on the wrong side of the trade, leading to losses when other, simpler funds might be doing just fine. Think of it like a sailboat captain in a race. A skilled captain can read the winds and adjust the sails to find the fastest route, potentially winning the race. But a wrong read of the wind can leave them becalmed in the water while everyone else sails past, or worse, sail them straight into a squall. A simple ferry boat, by contrast, just chugs along its fixed route. It will never win the race, but you know exactly where it's going and when it will get there. Dynamic bond funds are the sailboats. You're betting on the captain. So, who are these funds for? They are for investors who have a slightly higher tolerance for risk and who are willing to accept potential volatility in exchange for the chance at higher, actively managed returns. It's for someone who understands that the fund's performance depends heavily on the skill of the management team and is comfortable outsourcing those major interest rate decisions. But managing duration is only one half of the bond investing equation. So far, we've focused almost entirely on interest rate risk, the seesaw effect of rates going up and bond prices going down. But there's a whole other universe of risk and reward in the bond market, and it has nothing to do with the Federal Reserve. It has to do with a much more fundamental question. Will you get your money back? This is the world of credit risk. Every entity that issues a bond, other than the U.S. Treasury, carries some level of credit risk, which is just a formal way of saying the risk they won't be able to pay you back. The U.S. government is considered to have virtually zero credit risk because it can, in a worst-case scenario, print more dollars to pay its debts. But corporations can't do that. A giant stable company like Apple or Microsoft has an incredibly low risk of defaulting. But a smaller, younger company with a lot of debt is a different story. Just like people have credit scores, companies and their bonds have credit ratings, issued by agencies like Moody's and Standard & Poor's. These ratings, from the gold-plated AAA down to the speculative C or D, are simply an assessment of the borrower's financial health and their ability to make their interest payments and repay the principal on time. And this is where a different type of debt fund comes into play, one that actively seeks out this credit risk. These are called appropriately credit risk funds. Their strategy isn't about trying to predict the next move from the Federal. Their strategy is to earn a higher yield by lending to companies that are not considered top-tier, blue-chip borrowers. By law, a credit risk fund must invest at least 65% of its assets in corporate bonds that are rated AA or lower. They are deliberately moving down the credit quality ladder. Why on earth would anyone do that? For one simple reason: yield. The lower a company's credit rating, the higher the interest rate it has to offer to convince investors to lend it money. This extra interest is called the credit spread. It's the compensation you get for taking on the additional risk that the company might run into trouble. A credit risk fund aims to collect these higher interest payments from a diverse basket of dozens, or even hundreds of these companies. The idea is that the extra yield from all the companies that do pay will more than make up for the potential losses from the few that might default. When the economy is strong, these funds can be fantastic performers. Businesses are thriving, profits are high, and even the slightly riskier companies are easily making their debt payments. Investors in credit risk funds are happily collecting those juicy yields, often far surpassing what's available from safer government or high-grade corporate bonds. It feels like you've found a secret key to higher income. But the danger, as you can imagine, is when the economic weather turns. During a recession, corporate earnings dry up. What was once a manageable debt load for a company can suddenly become a crushing burden. The risk of default, which seems so remote during the good times, suddenly becomes very real. When this happens, the market value of these lower-rated bonds can plummet, because new buyers will demand a massive discount to own something so risky. This is the dark side of credit risk. A fund's net asset value can take a severe hit, not just from one company defaulting, but from the market value of all its holdings being repriced lower due to fear. Lending money to your incredibly reliable, wealthy friend for a 2% return is one thing. Lending money to your cousin for his risky new venture for a 20% return is another. The potential reward is huge, but so is the chance you never see that money again. A credit risk fund is essentially making hundreds of those cousin loans, hoping the winners pay for the losers. Because their fate is tied so closely to corporate profitability, these funds tend to behave a bit more like stocks than other bond funds. When the stock market is booming, credit risk funds are usually doing well. When the stock market crashes, they often fall right along with it. This means they don't always provide the same diversification benefit, that safe harbor effect, as a fund filled with U.S. Treasuries. They are a powerful tool for enhancing yield in a portfolio, but they are a satellite, an accelerant, not the core foundation. They are the spice, not the main course. We've now seen two very different philosophies for active management. The dynamic bond fund manager, who acts like a macroeconomist, positioning their portfolio based on big-picture interest rate trends. And the credit risk fund manager, who acts more like a private detective, digging into the financial statements of individual companies to determine who is creditworthy and who isn't. Both seek to outperform, but they take wildly different paths and carry wildly different risks to get there. And yet, there are funds that are even more specialized, focusing on one single type of issuer, to the exclusion of all others. And these ultra-specialized funds, they operate on a principle of exclusion. They're not trying to be everything to everyone. They are masters of a single domain. Think of them not as a general practitioner, but as a cardiac surgeon or a neuroscientist. They have one job, and they aim to do it better than anyone else. Let's start with the most exclusive club of all, government securities funds. In the US, you'll often see these called treasury funds. Their entire mandate, their sole reason for existence, is to lend money to the one entity considered to have the highest credit quality on the planet, the United States federal government. These funds buy treasury bills, treasury notes, and treasury bonds. That's it. No corporate debt, no mortgages, no state-level bonds. Just a pure, unadulterated bet on the full faith and credit of the US government. Now, why would anyone want this? In a word, safety. This is the financial equivalent of storing your money inside Fort Knox. The risk of the US government defaulting on its debt is, for all practical purposes in modern finance, considered to be zero. So credit risk? It's gone. Vanished. You don't have to worry about a company going bankrupt or a project failing. But, and this is a massive but, that doesn't mean these funds are risk-free. Remember our old friend, interest rate risk? It's the star player on this team. Because these funds hold government bonds, their value is still intensely sensitive to the actions of the Federal Reserve. If the Fed raises interest rates, the value of the existing, lower-yielding bonds inside that fund will fall. And if the fund specializes in long-term treasury bonds, say 20 or 30-year bonds, this effect is magnified enormously. A small change in interest rates can cause a big swing in the fund's net asset value. So while you've eliminated credit risk, you've placed all your chips on the direction of interest rates. It's a trade-off. You're swapping one kind of risk for another. A treasury fund isn't a savings account. It's a very specific tool for a very specific purpose, usually as the bedrock of safety in a larger, more complex portfolio. Now let's zoom out just a little bit. What if you want that government-level safety, but you're willing to take just a tiny step out on the risk spectrum for a little more yield? This brings us to funds that focus on what are called agency bonds. These are bonds issued by government-sponsored enterprises, think Fannie Mae or Freddie Mac. They're not directly backed by the full faith and credit of the US government in the same way a treasury bond is, but there's a widely held belief, an implicit guarantee, that the government would never let them fail. This perception means they are considered incredibly safe, just a fractional notch below treasuries, and because of that tiny sliver of difference, they have to pay a slightly higher interest rate to attract investors. For a fund manager, and for you, this can be an attractive proposition, near treasury levels of safety with a little extra income as a kicker. And in this same neighborhood, we find one of the most unique and powerful tools for American investors: municipal bond funds, or muni funds. These funds invest in debt issued by states, cities, counties, and other government entities to fund public projects, things like building schools, highways, or water treatment plants. Their credit quality can range from rock solid to somewhat speculative, depending on the financial health of the issuer. But they have a superpower. The interest income you earn from most municipal bonds is exempt from federal income tax. And if you buy a muni fund that invests only in bonds from your home state, the income is often exempt from state and local taxes too. This is called being double tax-free, or even triple tax-free. For high-income earners in high-tax states like California or New York, this is a game-changer. A corporate bond might offer a 5% yield, but after taxes, that could shrink to 3% or less. A municipal bond fund might offer a 3.5% yield, but that 3.5% is all yours to keep. Its tax-equivalent yield is suddenly much higher. So when you see a muni fund, don't just look at the stated yield. You have to look at its tax-equivalent yield to understand its true power for your specific financial situation. It's a specialist fund designed not just for safety, but for tax efficiency. From these government-centric specialists, we can move to another type of focused fund, one that narrows its sights on a specific sector of the corporate world. The most common you'll see are funds that concentrate on banking and what we used to call PSU, or public sector undertakings. In the US, a more direct parallel would be a fund that invests primarily in the debt of major financial institutions, think the big banks and government agencies. Why this combination? The logic is that major banks are the circulatory system of the economy. They are highly regulated and considered, in many cases, too big to fail. Combining their bonds with the bonds of government agencies creates a portfolio that is betting on the stability of the core financial and administrative infrastructure of the country. It's a step up in risk from a pure government fund, because banks can and do face financial distress, but it's still perceived as safer than a fund that invests across the entire corporate landscape, from tech companies to retailers to manufacturers. You're giving up diversification across industries in exchange for a concentrated bet on what you hope are the most stable and enduring pillars of the economy. But what if your biggest fear isn't a company going bankrupt, but the slow, corrosive effect of inflation and rising interest rates? What if you wanted a debt fund specifically engineered to fight back against the Fed? For that, there's another specialist, the floating rate fund. This is a genius concept. Almost every bond we've talked about so far has a fixed coupon, pays say 4% per year every year until it matures. That's great in a world of stable or falling interest rates. But when rates are rising, that 4% starts to look less and less attractive compared to the new bonds being issued at 5% or 6%. And so, the value of that 4% bond falls. A floating rate fund sidesteps this problem. The bonds it holds don't have a fixed interest rate. Instead, their coupon rate resets periodically, say every 3 or 6 months, based on a prevailing benchmark rate, like the Secured Overnight Financing Rate or SOFR. So, as the Federal Reserve raises interest rates, the benchmark rate goes up, and on the next reset date, the interest payments from the bonds inside the fund also go up. The result? The fund's income stream adjusts to the new, higher rate environment. And because the bonds don't get locked into a subpar yield, their price is much more stable when interest rates are volatile. They have very low duration, very low interest rate sensitivity. It's a fund built for a specific economic climate. It typically won't give you the highest returns when rates are stable, but when rates are on the march upward, it acts as a powerful defensive tool, protecting your capital in a way that traditional bond funds can't. So you see, moving into these specialized funds is about making a very deliberate choice. You're no longer just buying debt. You're choosing your exposure with surgical precision. Do you want pure zero credit risk safety? A treasury fund is your tool. Do you want tax-free income? A muni fund is your specialist. Do you want to hedge against future rate hikes? You bring in the floating rate fund. Each one sacrifices broad diversification to become an expert in one specific strategy. With this knowledge, you now understand the landscape. From the ultra-safe treasury funds to the broadly diversified corporate bond funds, from the short-term liquid funds to the long-term duration plays, and now these highly focused specialists. You know the players on the field and what positions they play. It seems like you have everything you need to start building your portfolio, but this is where the most dangerous mistakes are made. Because knowing the categories is just the first step. The second and far more critical step is learning how to read the fine print and analyze the specific fund in front of you. It's about looking past the name and the marketing to see the real risks hidden inside. And many of these risks are hiding in plain sight, in numbers and tables that most investors either ignore or completely misunderstand. And the first one, a single percentage point that can make or break your entire investment, is a number that almost everyone gets wrong. That number is the yield to maturity, or YTM. And it is, without a doubt, the single most important forward-looking metric you can find for a debt mutual fund. While everyone else is staring into the rearview mirror, obsessed with 1-year and 3-year past returns, YTM is like the speedometer on your dashboard. It's telling you the potential speed of your investment right now. So what is it exactly? In simple terms, the yield to maturity is the total return you can expect to get from a bond if you hold it until it matures, until the day the issuer pays you back. It's calculated based on the bond's current market price, its face value, the interest payments it makes, and the time left until it matures. For a debt fund, the YTM you see listed is the weighted average of the YTM of all the individual bonds held inside that fund's portfolio. Think about that. It's not a guess. It's not a historical number. It's a mathematical calculation based on the current prices and promised cash flows of the assets the fund holds today. It's the closest thing you'll ever get to an honest estimate of the fund's potential annual return over the next few years, assuming interest rates stay relatively stable. But here's the critical mistake almost everyone makes. They see a YTM of, say, 7% and they think, great, I'm going to earn 7%. But they're forgetting about the silent partner in every mutual fund investment, the one who always gets paid first. I'm talking about the fund house itself, and their payment comes in the form of the expense ratio. The expense ratio is the annual fee that the fund charges to manage your money. It covers everything from the fund manager's salary to marketing and administrative costs. and it's deducted directly from your returns. So if the YTM is the potential speed of your investment, the expense ratio is the constant, unavoidable headwind you're driving into. It's the drag that's always slowing you down. The real secret, the simple piece of napkin math that puts you ahead of 99% of other investors, is to subtract the expense ratio from the yield to maturity. This gives you a much more realistic picture of your potential take-home return. Let's run a quick scenario. You're looking at two different short-duration debt funds. Fund A has a big, flashy advertisement. It boasts a yield to maturity of 7.5%. Looks fantastic, right? But you dig into its fact sheet and find it has an expense ratio of 1.2%. Then you look at Fund B. It's a less known, maybe less aggressively marketed fund. Its YTM is a little lower, at 7.1%. On the surface, it seems slightly less attractive, but its expense ratio is a lean 0.3%. The average investor, looking only at that top-line YTM, would pile into Fund A. But you, the smart investor, do the simple math. For Fund A, you take the 7.5% YTM and subtract the 1.2% expense ratio. Your potential net return is 6.3%. Now for Fund B, you take its 7.1% YTM and subtract the tiny 0.3% expense ratio. Your potential net return is 6.8%. Suddenly, the picture is completely reversed. Fund B, the one that looked less appealing at first glance, is actually the far superior investment. Over time, that 0.5% difference can compound into thousands of dollars. This is the power of looking at the numbers that matter. You're not guessing based on past performance. You're making an informed decision based on the fund's current structure and its built-in costs. But wait, we can't stop there. Because YTM and expense ratio tell you about potential returns, but they don't tell you the full story about the risks. The other side of this coin, the number that tells you how much your investment will wobble and shake when the market gets turbulent, is called duration. Specifically, modified duration. Now, this sounds intimidating, I know. It sounds like something you'd need an advanced finance degree to understand. But the concept is actually incredibly simple and intuitive. Duration, measured in years, is a measure of a fund's sensitivity to changes in interest rates. Here's the only thing you need to remember. The higher the duration, the more the fund's price will move when interest rates change. Let's use an analogy. Think of duration as a lever. A fund with a high duration, say 7 years, is like having a very long lever. A small push on one end, a 1% change in interest rates, is going to cause a huge movement on the other end, which is the value of your fund. A fund with a low duration, say 1 year, is like having a short, stubby lever. That same 1% push from interest rates will only cause a small, manageable change in your fund's value. Remember that seesaw relationship we talked about? When interest rates go up, bond prices go down. Duration tells you by how much. A fund with a modified duration of 3 years will, in theory, fall by about 3% if interest rates rise by 1%. Conversely, it would rise by about 3% if rates fall by 1%. This is your risk meter. It's that simple. If you are a conservative investor who can't stomach large swings in your portfolio's value, you should be looking for funds with a lower duration. If you're willing to take on more risk for potentially higher returns, or if you believe interest rates are about to fall, you might consider a fund with a higher duration. This reveals the fundamental trade-off in the world of debt funds. Generally, to get a higher yield to maturity, a fund manager has to invest in longer-term bonds. And longer-term bonds, by their very nature, have a higher duration. So more potential return often comes packaged with more interest rate risk. There is no free lunch. Anyone who tells you otherwise is selling you something. By looking at YTM and duration together, you can now assess both the potential reward and the potential risk of an investment. You can start to ask the right questions. Is this higher yield worth the extra volatility? Does this fund's risk profile match my own personal timeline and risk tolerance? But there's one last piece to this puzzle. One final check you must perform before you can truly say you understand a debt fund. Because a high YTM isn't just a sign of longer duration. It can also be a sign of something far more dangerous: low credit quality. Remember, a debt fund is just a collection of loans. The YTM is the average interest rate on those loans. So why would a company or a government offer to pay a higher interest rate on its bonds? Sometimes it's because they need to borrow for a longer period. But other times it's because they are seen as a riskier borrower. They have to offer a risk premium, a higher interest rate, to convince people to lend them money. This is where you need to glance at the fund's portfolio and look for the credit ratings. You'll see letters like AAA, AAA, and so on. AAA is the highest rating of creditworthiness, the gold standard. As you go down the alphabet, the risk of the borrower defaulting on their loan increases. If you see a fund with a sky-high YTM but its portfolio is filled with bonds rated BB or lower, what's known as junk bonds, that high yield isn't a gift. It's a warning sign. It's compensation for taking on a significant risk that the underlying companies could go out of business and you could lose your entire principal. So the 4 pillars of debt fund analysis are right there in front of you. Yield to maturity tells you the potential return. The expense ratio tells you the guaranteed cost that will reduce that return. Duration tells you the sensitivity to interest rate risk. And credit quality tells you the risk of the borrowers going bust. These 4 numbers found in any monthly fund fact sheet transform you from a passive passenger to an empowered pilot of your own financial journey. They allow you to cut through the marketing noise and the confusing jargon and see the true engine of the investment you're considering. You now have the toolkit. You have the diagnostic instruments. You understand the forces of return and the forces of risk. But this brings us to the final, most important question of all. How do you take this knowledge and actually apply it? How do you match the right fund with the right YTM, the right duration, and the right credit quality to your specific real-world financial goals? How do you build a portfolio that works for you? Let's build a portfolio. Right here, right now. Not a hypothetical one, but a framework you can adapt to your own life, using everything we've just learned. The most effective way to do this is with a strategy professionals have used for decades: the core and satellite approach. Imagine your portfolio as a solar system. At the center you have the sun. This is your core. It's massive, stable, and the gravitational center of everything. Then you have the planets orbiting it. These are your satellites. They each have their own purpose, their own timeline, their own mission. Your core portfolio is the foundation. Its job isn't to hit home runs. Its job is to not lose the game. The primary goals here are capital preservation and generating steady, predictable returns. This is the part of your portfolio that's built to withstand storms. So what kind of debt funds live here? We're looking for high credit quality and a moderate duration. Think of funds that primarily invest in U.S. Treasury bonds, high-grade corporate bonds from stable, blue-chip companies, the Apples and Johnson & Johnsons of the world. A corporate bond fund with an average credit rating of AA and a modified duration of, say, 4 to 6 years could be a perfect core holding. Why? Because the high credit quality means the risk of default is incredibly low. You're not worried about these companies going bankrupt. And the moderate duration means it provides a decent yield without exposing you to the wild price swings of long-term bonds if interest rates suddenly spike. This core is your anchor. It's the portion of your money that lets you sleep at night, knowing it's working for you slowly and steadily, like a glacier carving a valley. It's not exciting, and it's not supposed to be. Its job is to be reliable. Now let's talk about the exciting part, the satellites. This is where you customize. This is where you align specific funds to specific real-world goals. Each satellite is a mini portfolio with a single clear mission. Let's create our first satellite. Let's call it the Dream Home Down Payment Satellite. Your goal is to buy a house in 2 years. You have the money saved, but you can't afford to lose it in the stock market. And leaving it in a savings account feels like letting it get eaten alive by inflation. What's the mission? Capital protection above all else with a little bit of growth. The timeline? 2 years. This is a job for a low-duration fund. An ultra-short duration fund or a low-duration bond fund would be a perfect fit. Remember our discussion on duration? Since your goal is only 2 years away, you want a fund with a duration that's also very short, maybe around 1 year. This minimizes your interest rate risk. If rates go up, the price of your fund won't fall much. And as the bonds inside mature quickly, that money gets reinvested at the new, higher rates. You're matching the fund's time horizon to your own. You wouldn't use a fund designed for a 10-year horizon for a 2-year goal. That's like trying to cook a 1-minute egg with a low and slow barbecue smoker. Wrong tool for the job. Here, safety and predictability are paramount. Now for satellite number 2, the monthly income satellite. Let's say you're nearing retirement, or you're a freelancer who wants a more predictable cash flow to supplement your variable income. The mission is clear: generate regular, spendable income. Here, you might look at funds that explicitly state monthly income as a goal. You might also consider a fund with a slightly higher yield to maturity, or YTM. This is where you could, cautiously, introduce a small allocation to a fund with slightly lower credit quality. A strategic income fund, for example, might hold a mix of high-grade bonds and a small percentage of high-yield, or junk, bonds to boost that overall yield. The key word here is small. This satellite is about enhancing income, not recklessly chasing yield. You're accepting a little more credit risk for a bigger monthly paycheck, but it's a calculated, intentional decision, and it's segregated from your ultra-safe core portfolio. If this satellite hits some turbulence, the sun, your core, remains stable and unaffected. Let's do one more. Satellite number 3, the rate cut bet satellite. This one is more tactical. It's not for a specific life goal like a house or retirement. It's an opportunistic play based on your view of the economy. Let's say you've been following the Federal Reserve, and you strongly believe they are going to start cutting interest rates in the next 12 to 18 months. How do you profit from that? You go long on duration. Remember the seesaw? When interest rates fall, bond prices rise. And the longer the duration, the more the price rises. So, for this satellite, you might allocate a small portion of your portfolio to a long-duration treasury fund. This fund might have a modified duration of 10, 15, or even 20 years. If you're right and rates fall by just 1%, a fund with a 15-year duration could see its price jump by roughly 15%. This is how you use your knowledge of debt funds to actively position your portfolio to benefit from changes in the economy. It's a higher risk play, which is precisely why it's a small satellite, not your core. If you're wrong and rates go up, this satellite will lose value, but your overall portfolio is protected by your stable core and your other more conservative satellites. Do you see the power of this? The core and satellite approach gives you the best of both worlds. You have a large, stable foundation that provides peace of mind. And you have smaller, nimble satellites that you can tailor to every single one of your financial goals, whether they're 1 year away or 20. It transforms your portfolio from a random collection of investments into a coordinated, strategic machine where every single dollar has a specific job to do. The allocation between core and satellites is deeply personal. A young investor with a high-risk tolerance might have a 60% core, 40% satellite split. A retiree focused on preservation might be 90% core and only 10% in a single income-focused satellite. There is no one right answer. The right answer is the one that aligns with your goals and lets you sleep at night. And this isn't a set-it-and-forget-it recipe. You have to review it. Once a year, sit down and look at your portfolio. Has one of your goals changed? Did you get a new job? Is your view on the economy different? Maybe you've successfully saved for that down payment. It's time to cash out that satellite and put the money in the bank. Maybe you're now focused on saving for your kids' college. It's time to build a new satellite with a 15-year horizon. Your portfolio should evolve as your life evolves. Over these 10 parts, we have torn apart the world of debt mutual funds. We went from the absolute basics of what a bond is, to the complex dance between interest rates and bond prices. We demystified jargon like yield to maturity, modified duration, and credit ratings. We didn't just learn definitions, we learned the physics of how this market works. But the point was never just to learn about debt funds. The point was to gain control. It's about shifting from being a passenger in your financial life, hoping you end up somewhere nice, to being the pilot with your hands on the controls, charting your own course. Equities, the stock market, that's your engine. It provides the powerful thrust for long-term growth. But debt funds? They are your navigation systems, your rudders, your shock absorbers. They provide the stability, the income, and the tactical control to navigate the inevitable turbulence along the way. They ensure you actually reach your destination. You have just armed yourself with knowledge that the vast majority of people never will. You've completed a masterclass in an asset class that is the bedrock of global finance. But knowledge is only potential power. The real test begins now. It's not about watching, it's about doing. So here is your first simple assignment. I'm not asking you to invest $1. I'm just asking you to take one small step. The next time you have 10 free minutes, open your brokerage account, or even just Google it, and pull up the fact sheet for one single debt mutual fund. Anyone. And find 3 numbers. Its modified duration, its yield to maturity, and its average credit quality. That's it. Just look at it. Connect the concepts you learned here to a real-world example. Because by taking that one small step, you begin the journey. You start building the muscle of financial analysis. You start building the confidence to make your own informed decisions. You start building a future not based on luck or hope, but on a foundation of solid, unshakable knowledge. The goal was never just to understand an investment. The goal was to give you the tools to build a stronger, more resilient, and more prosperous life. Now you have them. Go build it.